Associate Professor in IIMT College of Management, Greater Noida, wants to discuss about capital structure. In this session, we have to discuss about what do you mean by capital structure and how do we plan it, and features of the capital structure. What do you mean by optimum capital structure, or factors or determinants which affect the capital structure? These things we have discussed in this session. Now, firstly, what is the capital structure? Capital structure, as shown their name, capital plus structure. It is a combination of two words, capital or structure. Generally, people are considering capital as only equity is there, but it is not so. Only equity is not treated as a capital. Capital, it means ki total amount which we have required for a business point of view. That amount which we have required for a business or to start a business is known as the capital or capitalization. For an example, suppose we have required 1 crore rupees for a business. To run a successful business, we have required 1 crore rupees. Then it means that 1 crore is a total capitalization, or total capital is 1 crore. Capital, generally we all know that there are two types of the capital: own capital or borrowed capital. Own capital, it is generally related to the equity shareholders, reserves and surpluses. And borrowed capital, it is also known as the loan capital. It includes debentures, preference shares, or bank loan, etc. Own capital, it is equity share capital. They are the owner of the companies. And debt capital, they have fixed obligations which we have to pay on it in the form of interest or preference dividend. And suppose we are using just the 1 crore rupees is required for a business point of view. Then how do we get it 1 crore rupees? How we get it 1 crore rupees? The formation of 1 crore rupees is known as the capital structure. It means that the capital is the total 1 crore rupees है, वो हमको किस तरीके से we can use it? How we can use it, like as we are using own capital or debt capital, कि कितना amount जो है वो हम equity share capital के थ्रू लेंगे and कितना amount जो है वो हम debentures के थ्रू use करेंगे. It is shown in the capital structure. Total capitalization, it means the total amount of the securities issued by a company, which includes debt, preference shares, equity shares, and retained earnings. And we all know that a company may raise its total capital from various sources of funds, like as shares, debentures, and other long-term borrowings. There is no fixed charges on equity shares, but on preference shares and debentures, it is compulsory to pay dividend or interest respectively, so that there we can say that it has fixed obligations which we have to pay at any cost. Thus, debentures and preference shares create fixed charges, and the cost of the debentures is less than the cost of equity shares, because it has only fixed obligations. It has no but in equity capital we have certain extra charges. That's why its cost is more than the debentures or preference shares. Now the following questions are answered in the capital structure. like as which of these securities may be issued for raising funds, कि किस type की security we are using as a raising of fund, whether it is related to the equity capital or it is related to the borrowed capital, and how much extent we can use debentures, and to what extent we can use issue debentures. And next questions we have to arise like that, ki what should be the ratio between equity and preference shares so that we are getting maximum benefit to the uh, company. And last one is what should be the ratio among different securities, and different securities like as shares, debentures or long terms, what combination we have to use so that the ultimate aim of the company, which is to maximize the shareholders' wealth at a minimum cost, can easily fulfill by this. In other language, we can say कि the capital structure refers to the uh, uh, combination or mixture of the debt or equity which a company uses to finance its long-term operations. Raising of capital from different sources and their use in different assets by a company is made on the basis of the certain principles that provide a system of capital so that the maximum rate of return can be earned at a minimum cost. It means why we are using capital structure, so that the ultimate aim, which we have already discussed with you, the ultimate aim of the company is to maximize the shareholders wealth, and shareholders wealth can be maximized by only two ways, by reducing the cost or by increasing the sales or return. This sort of the system is known as the uh, capital structure. Uh, in other terms, capital structure is the mixture of the debt, preference shares, equity shares, and retained earning as shown in the slides also. And next one is capital structure can be defined as the mix of the own capital. In own capital, we can include equity, reserves, and surpluses. And borrowed capital, like as debentures, loan from banks, financial institutions, etc. Maximization of shareholders' wealth is prime objective of a financial manager, which I have already I told you. The same way be achieved if an optimum capital structure is designed for a company. The company has so many options, but the company use only this option which we can maximize the shareholders' wealth. We have discussed in earlier. And planning a capital structure is a highly psychological, complex, and qualitative process. A qualitative process because we are deciding how much debt we have to use and how much equity we have to use so that our return can be maximized or cost may be minimized. It involves balancing the shareholders' expectations and capital requirements of the firm. Capital structure we are using so that key shareholders' expectations like as a highly return and low risk is easily can be fulfilled, and capital requirement of the company is also fulfilled. So that is the optimum capital structure. Uh, a capital structure pattern and forms of the capital structure following are the forms of capital structure. It means in capital structure what is the combination of debt and equity. There are so many forms of the capital structure, some of few of the some of them. First one is complete equity share capital. Suppose we are using only equity share capital as a total capitalization amount. The first formation of the capital structure. And second one is the different proportions of equity and preference share capital. In this, we are using two sources of funds, equity shares and preference share capitals. And the proportion equity and preference which gives maximum benefit to the company, we are using in a capital structure. And third one is the different proportions of the equity and debentures. Ki, what proportion we have to take equity and debentures, so that ultimate aim of the firm to maximize the shareholders' wealth can be easily fulfilled. And last formation of the capital structure is different proportion of equity, preference and debentures capital. It means ki in this formation of capital structure, we are using three sources of funds. Equity shares, we have to use it. Preference shares also we have to use it, and debentures also we have used as a source of fund. I want to clear this example. Suppose we are a company is considering four different plans to finance its total project cost, which is rupees 5 lakh. The company has four plans, uh, and total requirement is 5 lakh rupees, and plan 1, plan 2, plan 3 and plan 4. Plan 1, we are using only equity shares. Uh, Equity shares of rupees 10 per share, which we have to use for the funds raised of rupees 5 lakh. In plan 2, we are using two source of funds, equity shares and 8% preference shares. Total amount is 5 lakh is required, and half of the amount of rupees 5 lakh, it means ki 2 lakh 50,000 through equity shares of rupees 10 per share each we have to get it, and 2 lakh 50,000 as a 8% preference share we are used in plan 2. And in plan 3, we are using two sources of funds, equity shares and debentures. Again, it is bifurcated in 50-50% of the 5 lakh, 2 lakh 50,000 through equity shares of rupees 10 per share, and 2 lakh 50,000 by the 8% of debentures we have to plan in plan 3rd. And plan 4, we are using three sources of funds. 2 lakh 50,000 through equity shares of rupees 10 per share, and 1 lakh is through preference shares of 8%, and 1 lakh 50,000 is the debentures of 8% debentures. It means ki in we have four plans, and the capital structure, the funds raised in all the four plans are different. Which plan is the more beneficial to the company? It is shown through the example. The expected earning before interest and taxes is rupees 1 lakh, and corporate tax is 50%. In further, we can see which plan is more effective in the form to satisfy the firm's needs or shareholders' wealth. First, before solving this, we want to discuss about EBIT, EBT or EAT. EBIT, it means ki earning before interest and tax. When we are investing some funds to invest, then we have to some earnings, and in this earnings we have to include interest or taxes also, so that it is known as the earning before interest and tax. After this earning before interest and tax, we have so firstly we have to deduct interest on debentures on it, then comes EBT, and EBT, it means ki earning before tax. After deducting tax, it comes EAIT, it means ki earning after interest and tax. इट इज अ फॉर्मेट टू गेटिंग इक्विटी पर शेयर, है ना, कि सबसे पहले हम ईबीआईटी को लेते हैं। ईबीआईटी में से फर्स्ट हमारा प्रेफरेंस जो रहता है वो डिवेंचर होल्डर्स को जो इंटरेस्ट देना होता है उसको हमने पहले लेस करना होता है, जिसके बाद जो हमारा बचता है उसको हम बोलते हैं ईबीटी, अर्निंग बिफोर टैक्स, है ना। और टैक्स को लेस करने के बाद में जो हमारा बचता है वो होता है अर्निंग आफ्टर इंटरेस्ट एंड टैक्स। और अर्निंग आफ्टर इंटरेस्ट एंड टैक्सेस के बाद में जो प्रेफरेंस शेयर होल्डर्स होते हैं जिनको की प्रेफरेंस मिलती है डिविडेंड पेमेंट में, उनका प्रेफरेंस शेयर्स को डिविडेंड देने के बाद में जो बचता है दैट अमाउंट इज यूज्ड फॉर द अर्निंग अवेलेबल फॉर शेयर होल्डर, इट इज द एग्जिट अर्निंग which we have to use, you know. And in plan 1, the slide shows that in plan 1 EBIT in all the 4 plans is 1 lakh rupees. In all 4 plans EBIT is same for the all the plans. In plan 1 we are not using debentures, so that we are not deducting interest on debentures in first plan. It remains 1 lakh as a EBT, and in plan 2 we are not using debentures, so it also EBT is 1 lakh. In plan third we are using debentures of rupees 2,50,000, 8%. The amount of interest on debentures is 20,000, which we have deduct from the rupees 1 lakh. It comes 80,000 as a EBT in plan third. And in plan 4 we are using 1,50,000 as 8% debentures. It comes total amount of interest is 12,000 and it is deducted from rupees 1 lakh. It comes 88,000 as a earning before tax. Getting earning before tax, we next process we have to done is less the tax at the rate of 50%. It is already given in the questions. So 50% tax is deducted from EBT in first plan. It means ki 50,000 is deducted from 1 lakh, then comes 50,000 in plan 2. 50,000 also is a tax amount. It is deducted from 1 lakh. It comes 50,000. And in plan third, 50% of the 80,000 is 40,000 and it comes 40,000 as a earning after interest and tax. In plan 4, 44,000 is a tax amount which is deducted from 88,000 and it comes as a earning after interest and taxes 44,000. It is a EAD earning after tax, interest and tax. It is, and after this we have to deduct preference dividend if we are using preference shares. In first plan we are not using preference shares, so there is no deductions of the preference dividend, and in plan 2 we have used preference shares, so the preference dividend amount is 20,000 which is deducted from earning after interest and tax 50,000, it comes 30,000. In plan third, 40,000 amount is total earning after interest and tax, and we are not using preference shares in this plan, so we are not deducting any preference dividend in this plan, and total amount which is available for the equity shareholders is rupees 40,000. Clear? And next in plan 4 we are using again preference shares, and the amount of preference dividend is 8,000 which is deducted from 44,000, it comes 36,000 at a earning available for equity shareholders. It is the exit earning which is allocated to the existing shareholders, है ना. Or in plan 1 existing shareholders, it means the number of equity shares. For calculating earning per share we have two things are required. First one is the earning available for equity shares, and second one is number of equity shares. Both are available here. Then we can easily calculate ki what is the earning per share. You know, and in plan one, earning per share is 50,000 divided by 50,000. It comes rupees 1 per share. If we are using only equity share capital as a fund raise or as a total capitalization amount, we have getting earning per share is rupees 1 per share. And in plan 2, 30,000 divided by 20,000, it comes rupees 1.20 per share. In plan 2, we are using preference shares and equity shares. It means कि if we are using preference shares and equity shares in capital structure, the amount for equity per share is 1.20 per share. In plan third, uh, the amount of equity per share is 1.60 per share. It comes after calculating this 40,000 divided by 25,000. It comes for 1.60 per share. In this plan, we are using debentures or equity as a source of fund. And in plan 4, we are using the equity shares, preference shares, and debentures as a source of fund, and the earning per share is 1.44 per share. In all these four plans, the maximum EPS is in plan third, which is 1.60 per share. इट मीन्स कि कहने का मतलब ये है कि अगर आप जो प्लान थर्ड हम यूज कर रहे हैं जिसमें कि हमारा जो ईपीएस है अर्निंग पर शेयर इट इज मैक्सिमम 1.60, तो कंपनी इज प्रेफरिंग टू execute the plan third, in which we have to use equity and debentures. Four plans we have in our scenario, but we have used only we can use execute only the plan third, which is give maximum benefit to the shareholders, which is the ultimate aim of the company. I told you the ultimate aim of the company is to maximize the shareholders wealth, and maximize to shareholders wealth, which we can show in this example कि EPS is higher in the plan third, so we will prefer to the plan 3. It means कि if we have required rupees 5 lakh, then we have to use only two types of the sources of funds, so that is equity share capital and debentures of 8% debentures. It means कि in 5 lakh, 2 lakh 50,000 we are getting equity per share, equity shares, and 2 lakh 50,000 through debentures. This is the this is also known as the capital structure planning. The mix of debt, preferred stock, and common stock the firm's plans to use over the long term to finance its operations. And next, we have to discuss features of an appropriate capital structure. Optimum capital structure. It means which gives maximum benefit to the company or shareholders. The optimum capital structure is that capital structure at that level of debt equity proportion where the market value per share is maximum and the cost of capital is minimum. It is shown through the prior examples also. Optimum capital structure is also known as the standard capital structure or ideal capital structure also. Appropriate capital structure should have the following features. First one is a simple capital structure. Key capital structure should be very simple. It is easy to understand every investors, and investors have clear picture about their wealth and rights of the investment, so that they can easily ready to invest their money into the company. And second one is the profitability and return. every firms want, or every investors want the higher return. Higher return can be possible by only two ways: by reducing the cost or by increasing the sales. It means ki by using the optimum capital structure we are using, it means ki it gives maximum benefit to the shareholders. And third point is solvency and risk. Uh, Cost and risk, there are two factors which affect the capital structure. Uh, if we are using the, we have discussed own capital and loan capital also. Generally, it is said that loan capital, cost of loan capital is less than the own capital, but risk is very high in the loan capital rather than the uh, equity capital, because uh, if we are not fulfill the requirement of the debt capital holders, then they can easily claim with the company properties also. And next one is the flexibility. Ki capital structure should be flexible. It means ki it has changed in time to time, so that we can easily modify it. And next one is the attractive for the investors. In capital structure, they have so many plans so that investor can attract to invest their money into the firm. Control, ki the in control, it means ki the capital structure should be in control over the, it is the adequate safeguards should be taken to see that despite the issue of new securities in the future, the control over the management is retained. Ki if we are using new securities, there is easily cope up with it. That means ki control is in our hands also. And next one is the determinants of capital structure. कि how do we decide कि कितनी इक्विटी आपको यूज करनी है, कितनी डेप्ट कैपिटल यूज करनी है, किस तरीके से आपको करना है. तो what are the determinants of the capital structure? First one is the nature of business. Next, money market conditions, stability of earning, capital requirement, desire to retain control, long term interest to the company, legal requirement, nature of asset of the company, general level of. Firstly, we have taken nature of the business. Nature of the business, the nature of the business can have a strong effect on the pattern of capital structure. A business with fixed and regular income can safely rely on the debentures or preferentials. If it is in irregular nature, then we are using equities should be preferred. And second point is money market conditions. Ki during boom period, investors are ready to go into the equity shares with the expectations of high dividends because boom period is there. But in time of the depressions, they will look for safety point of view and they are preferring to invest in the debentures or preference shares. Stability of earning. If the decisions about the types of securities to be issued should be taken in the context of the earning of the company. If earnings are regular and steady, preference shares are preferred. And next one is the capital requirement. Capital require, if a small amount is capital is needed, then only one type of the security it is related to the equity shares can be issued. But if a large amount of capital is required, it will be necessary to issue different types of the securities. And next one is the retained control. In preference shares and debentures have no voting rights. Everybody knows, and more funds can be raised through the issue, and the same control of the company can be retained by the existing management. And next one is the long-term interest of the company. Sometimes it happens that the types of the security which seems appropriate for from the point of view of money market conditions is not appropriate from the viewpoint of the long-term interest of the company. Legal restrictions, the company have to comply with the all legal provisions regarding to issue of different types of the securities which we have used in the capital structure. And nature of the asset of the company, if a value of company's asset is subject to wide fluctuations, then it is advisable to issue debentures. The company will have to rely on equity shares only. And general level of interest rate, the rate of interest should be taken into account while deciding the types of securities to be issued. If interest rates are high, then people are preferring to issue the ordinary shares. If interest rates are low, then it is advisable to issue the debentures only. And attitude of investors, it is desirable to issue securities of different kinds of the obtain subscription from the people with different attitude of preferences. And taxation policy, if taxation policy is very high, then people are using debentures, otherwise people are using equity shares. And last one is the cost of financing. The cost of financing differ from security to security because of in necessity it is relatively high in financing today's through the equity shares because there are so many expenses which we include in the equities. On the other hand, issue of debentures necessities lower expenses as debentures are regarded as a safe investment. Thank you. Thank you so much.